Hey guys, hope you're doing well. Today I want to talk about a popular ETF, which is SPHD, and I want to know or I want to find out whether the dividend is safe. Now, with an ETF, we kind of are conditioned to believe that ETFs are safer, and to an extent, this is true. The one thing about SPHD is what it is invested in. So, what you need to do when you start looking at some of these ETFs now is you really need to, they're no longer um, what I would call like blind investments where you just buy it and you just know that that's a good investment. You really should do some deeper dives into some of these ETFs, um, because these are passive investments. So what that means is most ETFs will rebalance their portfolio once a year, sometimes twice a year. And let's just go over SPHD a little bit and we'll dive a little deeper. Um, it is the Invesco S&P 500 High Dividend Low Volatility ETF that seeks to track the investment results before fees and expenses of the S&P 500 Low Volatility High Dividend Index. So what does that mean? That means the fund tries to match what the S&P 500 put together and called the Low Volatility High Dividend Index. So it's the S&P, the Standard & Poor, puts together these indexes, and these ETF issuers like Invesco assemble products to mirror what the Standard & Poor has put together as an index. I hope that makes sense. Now they can do like S&P 500. I think. Let me see if it describes it here. Yes, it does. So they can, as long as they can track the index, they try to track the index that the S&P creates as closely as possible. So you'll see the fund will generally invest at least 90% of its total assets in the securities that comprise the underlying index, which is the S&P Dow Jones Indices LLC. Compiles, maintains, and calculates the underlying index, which is composed of 50 securities in the S&P 500 index, that historically have provided high dividend yields with lower volatility. Strictly in accordance with its guidelines and mandated procedures, S&P DJI identifies from the S&P 500 index the 75 securities with the highest dividend yields over the past 12 months, with no one sector within the S&P 500 index allowed to contribute more than 10 securities. So if they look at the 75 and say 15 of them belong to consumer staples, let's just throw that out there, they can't do any more than 10, or they can't own any more than 10 in that index. So from those securities, S&P selects for inclusion in the underlying index the 50 securities with the lowest realized volatility over the past 12 months. Volatility is a statistical measurement of the magnitude of up and down asset price fluctuations over time. So the underlying index weights each stock by its dividend yield, with the highest dividend yield securities receiving the highest weights. And this is what the fund tries to replicate. The fund employs a full replication methodology in seeking to track the underlying index, meaning that the fund generally invests in all of the securities comprising the underlying index in proportion to their weightings in the underlying index. So what does that mean? That means it's a passive investment. So all SPHD does is they look at the index that the S&P has compiled from their criteria, and they invest in all those however the S&P weighted it in their index. So just a couple of things here. High dividend paying securities risk. And this is where I'm going to get into where I say you should be doing a little bit more deeper dive in some of these ETFs. Securities that pay high dividends as a group can fall out of favor with the market, causing such companies to underperform companies that do not pay high dividends. Also, changes in the dividend policies of the companies in which the fund invests and the capital resources available for such companies, dividend payments may adversely affect the fund. Now, here's where I'm talking about. Now, I believe, I didn't see it here, but usually they'll turn over their, it doesn't say when. They have a turnover rate of 43%, but I know because in my research I've seen twice a year S&P rebalances the index. So they'll go in January. I think it's January and July. I could be wrong. Could be January and June. They'll go in and they'll evaluate based on the criteria that they have for the index. So if any company in that index do not meet the criteria, they are dropped from the index and they're replaced with something else. So what that does to a fund like SPHD is they have to, by rule, because this is a passive investment and it's a rules-based fund, they have to sell off what S&P removed from that index, and they have to buy what S&P put into the index. I hope that makes sense. And the thing about it is they have to sell whatever that was removed from the index regardless of the performance of that stock. So, if it's a we'll go through a couple of the stocks and I'll show you what I'm talking about. But here's what I mean. Look, index risk right here. This is an important paragraph. Unlike many investment companies, the fund, which is SPHD, does not utilize an investing strategy that seeks returns in excess of its underlying index, which is from the S&P. Therefore, the fund would not necessarily buy or sell a security unless that security is added or removed, respectively, from its underlying index, even if that security generally is underperforming. So it doesn't matter whether it's underperforming, overperforming. If it's removed from that index, SPHD has to 86 it and bring in whatever the S&P included in the index to replace it. I hope that makes sense to you guys. So let's take a quick look at SPHD and look and see what their do I have it already open? Oh yeah. Here is their basket holdings as of March 30th. Well, let's group this. I'm sorry that this is probably very small. Did that group it? That did not group it. Sector industry. Oh, maybe if I clicked here. There we go. So financials, it's only got a couple of stocks. That hasn't been hit very hard. Healthcare, they only got 2 stocks. They're pretty good. Industrials, they have UPS and 3M. That's good. Technology, they have IBM. That's probably good. Materials, International Paper, and Amcor. I'm not sure about Amcor. But here's where we can have some issues in SPHD going forward, especially when they go to rebalance. And that's real estate. You have Vornado Realty Trust. I'm not sure what they're in. Simon Property Group. Now, if they decide to suspend their dividend, they can be removed from the index. And I know Simon, was selling for like $120 or more earlier this year, and now they're probably half that. So if it stays that way, and Simon, decides to cut the dividend, or they don't qualify to be in the index anymore, SPHD is going to have to sell out of Simon Property Group at a loss. Same thing with Ventas. Health Peak Properties, they have some exposure to senior housing like Ventas does, and they're having some issues. Iron Mountain's probably fine. Host Hotels and Resorts are having issues. They're a high quality company, but I read that they are having some, there are definitely, hotels are being hurt, and they are pulling all the credit that they can get. Kimco, I couldn't find much news on them, but they're definitely hurt. They're down 50% too. Public Storage usually is probably okay. Utilities are probably going to be okay. Let's go to page. Wait, was that page 2? Let's go to page 2. That was page 2. That's interesting. Let me go to page 1 then. Communication services is probably fine. Here we might have some problems with GM. Obviously, automotive has been almost frozen, so they may have to cut their dividend and be kicked out of the index. H&R Block is having some trouble right now. I was a fan of H&R Block, but they are delaying tax returns now, so that's going to impact their business, at least temporarily. But if it's impacted enough, they could be kicked out of the index. Let's go down here a little further. Here's where it could get interesting. Another interesting part is energy in SPHD. Not too familiar with Williams Company. Kinder Morgan, I know they have a lot of debt. ONEOK, I'm not sure. Chevron and Exxon are the majors. I don't think they'll cut them, but if they do, they will definitely have to be kicked out of the index, and they're down big time. Financials are I don't think we're going to have a big issue with financials. Let's see. And that's it. Utilities. So that's what I would look at if I were you guys looking into SPHD. See, if you're comfortable holding some of these, because when you buy an ETF, you are an owner of, all the companies in the underlying fund that it holds. And it looks like, some of these companies could be, iffy, and they'll be selling these at a loss, which could impact returns of the ETF. So that's all I got. That's just an interesting exercise that you can do to find out whether you want to invest in this ETF, and you can do that with any ETF. The main thing with SPHD that probably is its weakest point is that it is only 51 holdings, whatever it is. So, if one sector, like the real estate sector, gets hit, that's 20% of the fund that's getting hit. What else is getting hit in here? Consumer discretionary, that was only 3%. But this is 19% real estate, and those things are getting hammered. So that's why you are now seeing SPHD very cheap right now, and the dividend really high. But I would tread with a little caution, especially when the rebalancing happens of the S&P index that it tracks, and we'll see how dividends go going forward. But anyway, I hope you enjoyed. If you hold SPHD, have you looked at the holdings? You know, that's why I like major brokers, because they have this. You know, a lot of places you'll only be able to find the top 10. Here you have all the holdings as of March 30th, 2020. So it's usually updated daily, or at least one day away. So at least you know you have an current holdings listing, and that seems to be an issue on some websites. So anyway, I hope you enjoyed. Leave me a comment down below. Like, share, subscribe, do all that good stuff, and we'll talk to you later. Thanks. Bye bye.